With a new intraday record high for the benchmark blue chip FTSE 100 index in the last few days, driven in part, we're told, by the incredible shrinking pound, helping the export-led businesses that make up much of the FTSE. What about the small cap market post-referendum? Paul Scott from Stockopedia joins us now with some more analysis. Paul, welcome back.
Thanks, Jerry.
Because we spoke to you in the wake of the referendum and things were still very much in motion then. What about the small cap space since the referendum in the last 3 months or so?
Well, it's been remarkably strong. Things bottomed out on the 27th of June. We spoke about a week after that, where there'd been an initial bounce after the Brexit vote. There was then a further dip, but then since then a sort of steady, sustained rise. So from the low point on the 27th of June, the small caps index SMXX is up 18.7%. And both AIM and the mid-caps index are both up 22.5%, which is pretty remarkable stuff.
What about some elements that have contributed to some of this? I mean, we're talking there about FTSE 100 stocks benefiting from the shrinking pound. How has this helped or hindered your small cap case?
It varies on a stock-by-stock basis. Smaller caps tend to be more UK focused than the FTSE 100, but there are plenty of them that also have overseas operations. So when we last spoke, I flagged up the fact that people need to look at each individual stock they hold, see what the geographic spread of turnover and profits are, and the companies that have some sort of overseas earnings have tended to fare a lot better.
What about other aspects of the markets? Because we've seen in amongst the blue cap space some big gainers, notable gainers, and some notable losers. Yeah. It's quite polarised. Is that replicated in the small cap?
Very, very much so. That was really one of my key points to mention today. It's becoming extraordinarily polarised in small caps. Companies that are putting out really positive trading updates are going up, but then they carry on going up, and you think, well, hang on, what's going on here? When they're getting to what I would consider to be fairly valued, they'll do another 20, 30, 40% above that in some cases. And the opposite is happening on the underperformers. Any company that puts out a disappointment, particularly if it's a growth stock, a widely followed growth stock on a high rating, it'll just be slammed down. So Crawshaw's is a good example of that. Yeah.
Well, we'll get on to some of the individual stocks. One other thing I want to talk about is the banking crisis in the Eurozone at the moment. Yeah. How worried, as a small cap investor, how worried are you about some of the potentially big events that are looking as though they could mature?
Yeah, I'm getting increasingly worried about it. I mean, the Deutsche Bank situation, the figures look absolutely horrific. That its derivatives exposure, the market is clearly saying that it needs recapitalising, and then the politicians are saying, no, we're not going to recapitalise it. Well, if they're carrying in that vein, we're heading straight back into another major banking crisis, I fear. So yes, I am worried about that.
And of course, small caps get sucked down in the vortex, doesn't it?
It'll be, yeah, I mean, the thing is, I think after 2008, the politicians and civil servants know what to do. They have to forcibly, if necessary, recapitalise banks, but they don't seem to be recognising that now. So I think we could end up in another crisis before they actually do what's needed. Yeah. So
okay, let's take a look at some of your picks that you brought along today. And in fact, you mentioned about the fact that some stocks just go up and keep on defying gravity. Yes. And I know that you want to start, if we can, on a stock called Boohoo.com, which is this almost parabolic rise.
It's incredible, isn't it? And this has been my biggest success of the last 2 years. My blog readers a lot of them have followed me into this one when I backed up the truck and bought personally and for clients when it was sort of 23, 24p. So, I mean, I never imagined in a million years it would five-bag within less than 2 years, but it has done. It's an absolutely brilliant company, fantastic company, but the valuation now, I have to say, I mean, it looks very toppy. But you could argue it's just caught up with the valuation, the rating that ASOS was on. Yeah. And in some ways, I think Boohoo is actually a better company than ASOS. Much higher profit margins. It's got all the international growth. Although at this level, personally, I have been selling.
Yeah. This is an internet retailer. How about other internet retailers to compare against?
Well, the two that have caught my eye, one is called MySale, ticker MYSL. This is mainly based in Australia, funnily enough, but it's listed in the UK. It's backed by Philip Green. He owns about 23%, and also Sports Direct.
We're talking BHS,
yes,
Philip Green?
Yes, we are. So, and it's also got Mike Ashley as a major shareholder
Right.
as well. So you could either look at that positively or negatively, given recent publicity.
But lots of retail experience anyway,
exactly.
depending on how you view it.
I mean, they really know what they're doing, and also MySale's recently announced a sourcing deal with Sports Direct, which is going to basically use MySale as its clearance outlet in Australia. It's also got an up-and-coming British website, which is small but is growing well into triple digits in percentages. So although, again, as with Boohoo and ASOS, when you look at this on the fundamentals, it doesn't look cheap by any means. It has just moved into profit, MySale has, quite decisively. The margins are going up. The growth isn't high enough. I think top line growth is only about 10%. So that's not really enough to get it onto a really wacky rating. But this thing floated at £2 and it's only now at 90p. So I think that one, I mean, I hold that one and I'm sitting tight on it. I'm not selling any.
Yeah.
The other one was Gear for Music. Now, unfortunately, I tried to buy this through IG, but it's closing deals only. Right. So I'm hoping that we might be able to twist their arms to start making a market in this one. This is a music equipment online retailer. The last trading update was stellar, 73% organic growth. It's also profitable already, so it won't need to dilute shareholders. Market cap's not that much, 50-60 million at the moment. And they're breaking into Europe. European growth was in triple-digit percentages. They're targeting over 100 million turnover within the next 2 years. And it looks from the broker forecast as if they're going to actually hit next year's numbers this year. So I think that one looks potentially very interesting. And I hold that one as well, obviously, to be full disclosure.
Staying with the retail theme, I wanted to go into the butchery business, Crawshaw.
Crawshaw. Now, this one has been an absolutely amazing stock to own for people who got in early. I had a lot of friends who bought into this when it was sort of 4p or something, and it 20 bagged, went up to 80p. On expectations for the rollout of this hybrid sort of high street butchers and also hot food. Putting the two together seemed to be working very well. Well, until about 2 weeks ago there was this bombshell announcement. You can see the huge gap in the chart there. It was they announced that like-for-like sales were dropping, but they didn't give a figure. Which is always a mistake, and they seemed to cast doubt on the viability of the rollout. So it's spooked a lot of people and the price has collapsed from 80p to 30p. I have to say at 30p I am having a dabble on this. I think I didn't hold any before because it was just too expensive. The rating was wacky, but you know, these things, you get to a point where you start to think this might be a bargain.
Yeah, we should mention at this point, in fact, what you're doing is you're not recommending these stocks, are you, particularly? This is your own personal holding and what you are doing. Exactly.
I'm just giving an opinion on them, but I always urge my blog readers and everyone listening to this to really do your own research and don't because I might have missed something that they might pick up on. So.
Yeah, I mean, Crawshaw is a good example of what you were talking about earlier on about this polarisation going on, isn't it? About some bad news and all of a sudden the stock tumbles out of bed. Fairpoint's another one that you've got. Fairpoint Group. What's going on there?
Yeah, ticker FRP. Now this is a business which is transforming itself from, it used to do IVA arrangements for consumers who had problem levels of personal debts. That's now winding down, and they bought 2 firms of solicitors. So it's basically just a general legal services business. The results were out, I think, last week, and they were fine. 7p earnings in the first half, and they said the second half will be the same. So that's about 14p earnings. And look at the share price, 66p. So your PE ratio there is about 4.5. Now that's telling us either something's going badly wrong that they haven't told us about, or the thing's an absolute screaming bargain. And also the other thing, it does have some debt, but the debt is more than, well, roughly equally covered by the value of the IVA book, which should turn into cash. So when that's happened, it should be debt-free as well.
I was going to say, you're an accountant. What should you be watching out for to give you an indication that things are turning? It is the debt book.
Yeah, I mean, companies that are overly indebted can get into serious problems if trading breaks down.
But for something like Fairpoint, precisely what are you watching?
Well, I mean, I think it's another of these ones where the selling is feeding on the selling. It's going down because it's going down. Yeah. So more people... So that this thing, I think, is either an absolutely amazing bargain or there's something badly wrong that the sellers know about that I haven't picked up on. And I mean, the dividend yield on this is now 10%.
Yeah,
and they've just paid out a whacking great dividend, and they've said they're happy to maintain it. So
if you're maintaining and you're buying at these levels, 10%, so a pretty amazing yield to get on.
Yeah, I mean, if nothing hideous comes out of the woodwork, then I think this share could easily have 50% upside on it. But I'm very nervous, so because it's relentlessly dropping. I've only bought a few. I can't. You know. Interesting.
What else you got going?
Another one I like is called Revolution Bars, ticker RBG. Now, I would emphasise I've only looked at this one for the first time yesterday, so it's a very interesting one. They're vodka, sort of high-end bars. They spend about £1 million on the fit-outs for all the new ones, so it's a retail rollout, basically, of swanky bars. But what's interesting about it is the PE ratio is very reasonable. Results yesterday were good. Obviously, as you bolt on more branches, you get a disproportionate rise in profitability. The other interesting thing with bars is they get retrospective rebates from the drink suppliers based on volumes. So a bars group, as it grows, will see improving margins. There's a dividend, and the other interesting thing, it's got no debt. So it's a self-funding retail rollout. I think that looks very interesting.
But the stock has dropped quite considerably, actually. If you look at this time last year when it was up around about the £2 level.
Yeah, I think it floated at £2.
So it's about 150 or something.
Yeah, it's about 25% below its IPO price, despite having served up good results yesterday. So I don't really understand why that sold off. There is a seller in the market. I've been picking up stock today repeatedly at £1.56, 4p below the offer price, and the seller's just sitting there. So somebody's offloading. Don't know why, but I think it looks very interesting, that one.
What about the stock of Lavendon? One of these companies, you say, seems good value as well.
Yeah, it does. Lavendon, ticker LVD. They hire out aerial access equipment, so sort of cherry pickers in various shapes and sizes. It's got overseas earnings as well, so it's not just UK. The Saudi Arabian business is highly profitable, so possibly the market is worried that that might contract, but it's got a very strong balance sheet as well for a hire company. I really like it. It seems to have done that sort of double bottom in July, August time. So the valuation metrics look very good on that, I think. So it's one I've held for quite a while. I bought more around about the £1.10 level. So who knows?
Yeah. I want to talk about a couple of outside runners. If we can, just to finish off with. Yeah, that's right. Yes. What have you got up your sleeve for things you're watching but not in?
I mean, these are complete punts. Well, not complete punts. There is some logic behind them. The first one is Johnston Press, JPR, the newspaper group. Now, I've been saying for years that the equity of this company is worth nothing, and so far I've been proven correct. As you can see, I mean, I'm talking 2, 3, 4 years ago. I was saying the equity was worth nothing because it's got massive debts, big pension deficits.
This company owns local newspapers, doesn't it?
It does, yeah. And of course, they're in deep decline. The latest circulation figures and ab revenues figures are down 10% year on year. You can only carry on cutting costs for so long. So it looks moribund, but look at the share price. The share price is option money only. The market cap's only about 15 million, and it's still generating about 50 million, 50 EBITDA. So there is if they can refinance the bonds and get the bondholders to take a big haircut, you never know. The equity could actually still have some value. And there's an activist fund called Crystal Amber buying the shares, and they've got a very good track record of being a catalyst for turnaround. So I don't know on this one. I was lucky. I bought at 10, 11p, so I'm in the money so far. It could double or triple, I think, from here if some sort of debt restructuring happened. At which point, thank you very much, I'd be out.
No, we've got to leave it there, Paul, because time has beaten us. But thank you so much indeed for coming in again to take a look in some more detail about some of the picks. And I must reiterate again that those are just Paul's thoughts and stocks that he is interested in. These are not recommendations and should not be taken as such. Paul Scott there with us from Stockopedia.com.